after news that they have reduced their debt exposure arising from corporate guarantee through prolific resolution. Now, this has happened. It's a significant development. Ayesha here to help explain and break this down. Ayesha, what do you have?
Well, yes, so they are clearly looking at deleveraging and reducing their debt, and that is clearly the reason the stock is up 3.5% today. The company informed the exchanges that they have reduced their debt exposure significantly. That is arising from the corporate guarantee that was issued to Prolific Resolution Private Limited. The company also said that they earlier transferred an aggregate debt of about 2,854 odd crores, along with 6,500 crores in awards and claims to PRPL. In fact, along with interest, this debt amount stands at about 3,935 odd crores. Now, HCC still retains about 49% stake in the company. The guarantee obligation has now been reduced from 100% of the outstanding amount. The company has clearly said that they are looking to deleverage, because of which they have undertaken this step. Current obligation now stands at just about 571 crores from about 4,000 crores earlier, representing nearly 20% of the total principal amount that was being transferred. So yes, big plans underway. Company is looking to reduce their debt, and that is the reason the stock is gaining 3.5% in trade.
Thank you so much for that, Ayesha, for bringing us that story with regard to deleveraging. But let's bring on board Unmesh Sharma, who's the head of institutional equities at HDFC Securities, joining us this afternoon. Unmesh, great having you. How are you placing your bets in this market, and how are you viewing the market at this point? Give us a sense of what you're looking at in terms of where the market is headed maybe 3-6 months from now.
Thanks for having me on your show. So it's been a very confusing market, in the sense that there has been one major crossflow, which is that on the global front there has been selling, and on top of that, the as people await the trade deal, there has been weakness in the currency. On the other hand, the domestic flows, including the data that was received yesterday, continue to remain very strong. As a result of this, what started to happen is that we've also seen that while the indexes are going up, if you look at client portfolios, especially those in multi-cap or small and mid-cap, have actually taken fair bit beating. So currently, what everyone wants to know is not just where the Nifty is going, but also whether there is whether the selling on that front will stop. So to answer that part in two parts, one is that if you look at headline Nifty, given the fact that despite the fall, it has been one of the worst performing global markets this year. Okay, at this point in time, in December, a lot of the FPIs do not take fresh bets, so we'll have to wait till January. But we recently visited the US, and what we found is that incrementally there doesn't seem to be that much interest in going further underweight on India. So, and that can show up a little bit, that has shown up a little bit on the abating of the selling as well. On the other hand, what's also happened is that the market's not really cheap. And as people start to look at what happens in the quarterly earnings, commentaries and outlook for the FY27, we will start to see the direction in the market. It looks like it will remain range bound with a clear bias towards large caps and only those small and mid caps where actually earnings delivery is certain. So next 3, 6, 12, 9 months, we expect to be extremely challenging. Our model portfolio has a strong bias towards large caps, has a strong bias on the mid caps, and very specific stocks, and to a large extent is domestic facing.
Okay. And Unmesh, so let's talk first about the global setup. Tariffs, you've got rate cuts across the world, and you've got a possible exposure to India, export-facing sectors, plus you've got a depreciating rupee. How do you play these 3-4 themes, which are more global-facing? IT, of course, is the one good way to play it, but at this point, is the risk-reward looking attractive there, or is there another way you play these themes?
So if you look at it from the index perspective, the big issue is that if you break down the earnings, The tariffs per se do not affect earnings as much because still dominated by domestic sectors. Uh, Having said that, that small component of IT and pharma to a large extent, which is driven by the foreign trends, is mostly indexed to the US. So from that perspective, it does make a difference. Now, in an environment where services have not been taxed and the H1B is really not such a big issue,
right?
And the depreciating rupee, the IT sector would have been an obvious one to bet on. The problem there is that
Unmesh, I have you on a bad feed, so I'm going to have to pause you there, and we'll come straight back. We'll try and repair that and come straight back to you for that answer. Kunal, within the IT pack, well, the move wasn't as pronounced as one would have expected. Largely, it seems that the IT pack had built in the 25 bips cut. So there was some zing initially, and thereafter we saw a very sharp cool off. And thereafter, the Nifty IT index has bounced back. Can we pull that up? And that'll give viewers a sense. Is IT looking ripe at this point? I know you're positive, but give us your top picks as well.
Yeah, so I think it's at current juncture, 1,000-point retracement from the last 3-day, 4-day swing high for the IT index. I think it's come back towards a good support point, support territory on the short-term charts. We've been discussing that a retracement of sorts for indices and larger cap names, which tend to go into a strong rally mode whenever these stocks go into a correction, say a broad 3%, 5% correction on the short-term charts. That generally becomes a good territory where traders could look at maybe a buy and accumulate further for many of these names. In that sense, I would continue to be bullish on larger cap IT names prominently. So I think Infosys, TechM, something which I think on the charts still look fairly attractive on the short to medium term basis. Coforge, Persistent are the ones which look attractive on the medium term charts on the mid cap arena from the IT pack.
Interesting. Okay. What we'll do is slip into a very short break. We'll continue conversation on the other side of it. Stay with us.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Good. Now, it up for detail.
All right, welcome back, and thanks for staying with us. We've got a marquee conversation with Seshadri Sen, Head of Research and Strategist at Emkay Global Financial Services. The call that Seshadri has made on the latest note that he's written is a call on the Nifty, 29,000 by end of 2026. But we'll come to you in just a minute, Mr. Sen. Before that, let me also bring on board Arpit Beriwal, Manager Derivatives Analyst, Equity Research at Motilal Oswal Financial Services. Arpit, how are you viewing the markets? What are the levels you're looking for right off the bat on the Nifty?
Very good afternoon to all. So if you talk about the headline indices first, if you look at the chart structure of Nifty first, so Nifty has been trading in a broader range between 25,700 to 26,250 levels from last almost 19 sessions. So the overall, if we see, there is a lot of difference in the market where Nifty Bank Nifty are at high levels, whereas the broader market is underperforming. So on Nifty, we are looking at the level of on the closing basis, major support is around 25,500, 25,600 levels, whereas on the upside, 26,200 is a stiff resistance. So our sense is that overall index is likely to consolidate between this broader band between 25,500 to 26,200 levels. On the immediate basis, 25,750 is a major support area, that is its 50 demo also. So we are closing watching that. But at the same time, 2650 is the major hurdle levels. Along with that, if you look at the Bank Nifty setup, so Bank Nifty is relatively outperforming. So if you talk about the Bank Nifty setup wise, it's trading in a broader range between 58,700 to 59,700 from last couple of sessions. And our sense is that till it holds about 58,500 levels, overall sense on Bank Nifty will be buy on dip stance, and that is also respecting to its 20 demo. So as compared to Nifty Bank Nifty is relatively outperforming with major support around 58,750 for an upside move towards 59,500, 59,750 zones.
Arpit, we'll pause you there. Let's go across. Seshadri Sen joining us. Seshadri, let me try and get your take. So 29,000 on the Nifty is what you're building it on. Talk to us about what the FY26 and FY27 earnings is going to look like according to you, that you're penciling in a 29K on the Nifty. What are you expecting in terms of valuations, and are you expecting a possibility of earnings surprise to the estimates that you've already built in, is what I'm trying to get to.
Yeah, thanks for hosting me. So 29,000, to clarify, is a December 26 target. That's 12 months away, which implies about a low single digit, around an 11% return on the Nifty in CY26, similar to what the Nifty delivered in CY25. We are penciling in about 7 to 8% earnings growth for FY26. There have been some idiosyncrasies because of composition changes there. But FY27 should be a 30 to 40% EPS growth. We are quite constructive on the broader economy, especially on the consumption side. We think that the multiple stimuli that have come through both from the RBI and then the government in the form of GST cuts. We had income tax cuts earlier this year as well. And at some stage in the next year, you'll have the pay commission. So if you accumulate all of that, plus there's been a lot of deregulation in many sectors, the main one in the financial services and lending space. So all of that will combine to cause a significant acceleration in consumption and the overall economic cycle. We are also expecting credit growth to pick up from, it's already moved from 9 to 11.5, and we're expecting a further movement to 13.3% in FY27. So all in all, we think FY27 there should be significant growth momentum, translating to a 30 to 14% Nifty EPS growth, and that's what we're basing our December 26 Nifty target on.
Fair point. Seshadri, how do you view the larger caps versus the mid and the small? Do you expect outperformance on the broader end of the spectrum? Because and how will earnings behave on both sides? Give us a sense of that as well.
From a one-year perspective, we continue to prefer small and mid caps. What we are saying is that the larger caps give you some insurance against market volatility. And in the short term, we do expect something on some volatility and some, sharp movement, bidirectional movement in the Nifty. But for alpha generation, for outperformance, we think small and mid cap is the place to be. That is where you're getting better growth. Not only are there some of the higher growing sectors which are exclusively small and mid cap, with very little large cap presence there. Even within some of the sectors like BFSI, IT, the smaller caps are delivering better earnings growth than the larger caps. So as the market gets into growth mode, we think the small and mid cap will deliver better performance than the larger caps. But it will be a volatile year, especially as we start the year. We expect quite a bit of volatility, and to protect against that, a bit of large caps in the portfolio should help.
So interesting that you say that, Seshadri, because everyone that we've been speaking with, the consensus seems to be that, it's not going to be the year of small caps and mid caps for sure, but large caps, like you also said, are the safer lot. But other than that, the problem with small and mid caps, and please correct me if I'm wrong here, is also about the froth pockets, right? I mean, you debate about what is it that you do with EMS, defense, all those kind of sectors wherein perhaps they've already had their heydays in the sun. Where is it that you feel that there is still exuberance or overvaluation within small and mid caps, and one needs to steer clear of those sectors?
It's a little more complicated than that. It's not whole sectors which are overvalued. There are specific companies in every sector which are overvalued. If you look at capital goods, it's a very large segment. It's very dominated by small and mid caps. There are, admittedly, very absurdly valued pockets, and it will be tough to get outperformance if you buy something in ATP, however good that stock is. But within each sector, you will find stocks that are not so egregiously valued, and some of which the valuations are supported by really supernormal growth over the next 2-3 years. So when you look at the growth adjusted valuations 2 to 3 years out, The current optically high Ps may not look so absurd. So definitely, within IT and BFSI are two areas where I think small and mid caps will offer much better opportunity than the large cap space. And within the so-called more expensive sectors, some of which you just alluded to, if you look hard enough, there will be some stocks which are in takeoff stage on growth. Valuation may look optically high, but if you really do your work and figure out the growth momentum, I think there is a lot of money to be made there as well. So, going back to your original comment on my being contrarian, I don't treat small and mid cap space as a monolith. The moment you start doing that, then it stops making sense. But it's a huge segment. If you take the whole market, remove the top 150 stocks, that's your small and mid cap space. There is plenty of opportunities there to make money. And I repeat, if you want to generate outperformance, that's where you should look. The large caps will offer very limited outperformance from here on.
And within mid and small caps, Seshadri, you believe it's going to be IT and BFSI?
Those are two examples that I gave. I think you should need to look at consumer discretionary is one space that in terms of our sectoral approach, we are actually underweight on IT and BFSI because we don't like the large caps there. And consumer discretionary is one space where we are particularly excited. It's a very large space, admittedly. If you want to slice and dice in auto and auto anchors there, will provide you a lot of opportunities. The internet space is something that we are very excited about. And almost every month there are newer stocks getting added to that space. And I think that's a really long-term growth space where you have to look through the near-term optical losses, etc. And if you pick the winners, I think they can show hyper growth for half a decade at least, if not longer. And once you account for that, then the valuations don't look so determined.
Seshadri, so within consumer discretionary, you spoke about auto as being one of them. Do you believe that some of the re-rating has already happened, or are you anticipating, and is it going to be bottom-up stories which you need to pick within this basket? Or is it going to be pretty much the whole auto pack which is going to benefit from the tailwind of the GST rate cut and of the policies with regard to reducing rates as well?
Bottom up. Certainly, I think you need to go bottom up in that sector. The first wave of GST benefits has come through. I'm not in the camp which says that this is a 1 quarter and done kind of phenomenon. The GST cuts will have a much more longer lasting effect on aggregate demand in the auto space. But however, from here on, obviously growth will moderate a little bit. And in that segment, you will have to pick out the winners, right? The companies that have the newer models, the company that have stronger brands, stronger distribution, which will outlast some. So, the phase of rising tide lifting all boats has gone. You will have to be selective from here on. Likewise with auto ancillaries. I think a lot of auto ancillaries have been sort of left out of this argument, but they also are slipstream beneficiaries of the resumption of the auto cycle. Or you'll also have to look at categories. We prefer passenger vehicles and two-wheelers over CVs and tractors, though there are signs of a turnaround in CVs at least. So you'll have to, one, divide it vertically and also look at individual companies, market positions, etc., the ability to sustain continued product and brand launches for them to be able to capitalize on what we think will be a relatively high growth year in CY26.
Okay. And on the consumer discretionary side, otherwise, Seshadri, outside of auto, you also like maybe air conditioners, maybe that sector, that space seems to be attracting your eye. Talk to us about rural versus urban. Is there going to be an outperformance in any one of these, or is it going to be pretty much across the board?
See, I don't like the rural-urban. I think the rural-urban divide is a bit artificial. I prefer to talk about premium and mass. At the moment, I would focus on premium. Longer term, I think mass. The mass segments had a bad time after COVID. About 3 years, mass segments struggled. I think from the earlier part of this year, partly because of the cash transfers in multiple states, partly because I think generally household balance sheets in poorer, in the lower income segments have largely been repaired. You are seeing some momentum. There is some worries about low inflation impacting crop prices and that impact, but that would be strictly short term. So the final answer to the question is that both premium and mass should do well. Both urban and rural should do well. So this would be a fairly broad-based consumption revival. I don't think it will be a narrow revival like we saw in the immediate post-COVID phase.
That really throws up so many more questions. Seshadri, we have to take a commercial break, but if I can just request you to stay with us, we'll come back and we'll continue our discussion with you.
Up for detail. The after cover. Yes, because this high. On the ground. This is now. Get for detail.
Back with closing trades right here on ET Now, and we're still in conversation with Seshadri Sen, Head of Research and Strategist at Emkay Global Financial Services. Seshadri, thanks for waiting by. I was just observing your thoughts on the entire consumption pack. And, clearly the government also seems to be aligned with that, given all the strategic moves that we've seen in the last 1 year or so. But tell me, what happens with the upcoming budget? Do you think there will be a further fillip or thrust to consumption? And would that then come at the cost of perhaps a capex slowdown?
No, I don't think there will be any further specific stimuli except for the provision that will have to be made for the wage pay commission that is coming up in the next financial year. Beyond that, the space for the government to be able to provide further stimuli is somewhat limited. I don't think that there will be any serious let-up in the government capex plans. The central government remains the most major player in the overall country's capex profile. Corporate India is unable to pick up that slack, so I don't think there will be any contemplation of slowing down. We expect state central government capex to grow largely in line with GDP, maybe 1 or 2 percentage points higher, in fact. Given what's happening in the bond markets, the scope for overshoot on the fiscal deficit is also fairly limited. So not really penciling in a further consumption boost in the budget that is coming up in a couple of months. It will be sort of a steady as you go budget, more following a path of continuation of existing policies rather than trying something dramatically new.
What about monetary easing, though? Do you sense that we could see further easing by the central bank through 2026?
Yes, I think that there will be some further easing. The commentary around the last cut seemed to indicate that there will be further easing. But I'm looking at easing on 3 fronts. Rate cuts is a small part of that, and we may see another rate cut if inflation continues along the trajectory that it is. And we do think that upside risks to inflation are fairly limited at this point in time. The second is liquidity, where I think the intent of the RBI is to keep the system liquidity at a reasonably healthy level, at least about 1%. The challenge they are facing on that front is that the pressures on the external account and the currency is pushing liquidity down in sporadic, especially when it needs to intervene to protect the rupee. So that is an equation which the RBI will manage, but there will be sporadic bouts where that liquidity is not available, and transmission will slow down to a little because of that. The third part is lending deregulation, where a lot has been done. Very frankly, the last 9 to 10 months, there's been very aggressive lending deregulation. You probably can expect a little more of that. One of the interesting things that has happened is that, foreign direct investment into banks. We've seen 2 foreign banks and 2 large PE funds being allowed to take significant stakes in some of the local banks. So that kind of reform, I think, will be pushed forward so as to expand the overall financial services industry. So you will see monetary easing, but some of it will be conventional, some of it will be non-conventional.
Chaudhary, you're underweight financials and especially the large cap financials. It's surprising here because you've got 4 out of the top 5 private sector banks trading at below and well below their 5-year price to book valuations. And even the PSU banks are not trading at materially expensive valuations, despite it being a very, very good asset quality cycle that we're currently seeing with growth likely to come back. Give us the rationale as to why you feel the larger ones won't do well. I know the mid and the small you're bullish on, so that point being made. But what of the larger ones?
It's a position I've held for the last 2.5 years, and I continue to maintain that. I think the historical ranges of valuations of private banks are irrelevant at this point in time because their growth rates are in a completely different zone. They used to grow in the 20 to 25% region when they were trading at four times price to book. Now that growth in a best case scenario is 15%. There is a big difference in the valuations of banks when the growth falls below ROE and they stop consuming capital. So in a best case scenario, we don't see them reaching that limit. Most banks will grow in a 12 to 15% range. And for that, a 2+ time price to book is difficult to sustain over time. That is the long-term view we have on large private sector banks, which is why we are underweight. We are very biased towards high growth. We prefer paying higher multiples for higher growth than trying to look for value in low growth stocks, especially when there's a theoretical mismatch in terms of valuation versus growth. So we think if you take a 3-year view, banks will further derate, even though 2.1 to 2.3 may look optically cheap compared to where they used to trade. But given their growth versus what used to be there, that's still not cheap enough.
Seshadri, so good having you on the show today. Thank you for your time.
Thank you so much for hosting me. Always a pleasure.
Okay, let me now welcome on board